What's up YouTube? It's Todd Horst here with Tasty Tracker, and today I wanted to do the second part in my strategy series, and that is Theta Overstated. The first video was Vega Overstated, and so this one is Theta. We'll get right into it here. So what is Theta? Theta is the Greek for time. So again, this is super easy to remember. Vega, V, volatility, V, Theta, and time both start with a T. So they couldn't have made it any simpler. And what are the Greeks generally speaking? They are the pieces of the puzzle that dictate the value of an option. And that's implemented through the Black-Scholes calculation, which I have a calculator on Tasty Tracker for you to play with if you want. So generally speaking, the more time you have, the greater the chances of a deep out of the money option to become in the money and to see that value come into it. So as we all know, options expire worthless if they're out of the money. So as an option buyer, your object is to buy something that's hopefully cheaper and a little bit out of the money, and then have the stock move your way for your option to then be in the money and then profit from that transition. So the more time you have, it makes sense then that it has more value. You're going to pay more. So if you are buying this week's option, call option for SPY, we'll say, and you think it's going to hit 300, then you only have, today's Thursday, so you only have 2 days left. That doesn't give you a whole lot of time to be right. And is it possible? Right now we're sitting at 293, 294. So it is very possible for us to hit 300. But it's going to be on the edge unless we have a bad day or two, and then it's going to be nowhere close. So now if I say, instead of expiring this week, we're going to get the one that expires in 6 months. What are the odds that between now and then, at some point, it will be over 300 in 6 months? I would say almost 100% chance that that's going to happen at some point. That doesn't mean you'll be able to exit out profitably. I'm just saying there's a very good chance we'll make $6 in the next 6 months. Okay, so yes, time has value. And typically speaking, an option buyer will pay more for that chance to be successful, that increased chance, and that's why expirations further out are much more expensive. They also move a bit slower, which is nice, and theta, which is what we're talking about, theta decay is something you'll hear about, and for very close expirations, the theta is really chipping away its value. And so you'll see the option prices move wildly around. But if you got further out, there's less volatility in the pricing of the option. So a lot of people are liking that, and they'll buy maybe 30 days or 30 to 90 days out. A lot of times if I'm buying something, I will buy it at least 90 days out because I don't want theta to erode the value. Okay, but I'm getting a little ahead of myself here. Sorry. So if buyers are paying more, that means that sellers are getting more. And that really makes sense, obviously, because the sellers need motivation to sell that contract, right? So there's increased risk if they give you more time. And so then they're going to collect more as the seller, and the buyer is going to pay more. They need to be compensated fairly, right? Or as fair as we can possibly compensate somebody. So this Theta and Vega really go hand in hand. If you believe that Vega is overstated, which I do, and there's documentation to prove, then you really have to apply that same logic to I'm sorry, I said Theta probably. If Vega is overstated, Theta is as well. So right here is the slide. I have the exact same text as the previous, but we'll go through it real quick. If you look into the future, how much uncertainty is there? A lot. in the past. How much of that uncertainty played out? Some of it, not all of it, obviously. Stocks spend a huge amount of time going nowhere. They'll go up, they'll go down, they hit the same resistance and supports, and then they bounce off of those, and then they'll do that a couple times before they finally break through. The future is filled with unknown, which fills people with emotions, greed, and fear. But looking back, it's much more muted than what anybody ever predicts. And so, yeah, I said, does that sound familiar? Because that's the exact same slide I had before. So for this one, before I said prove it, and I said I wasn't going to, and you can do your own research. And I linked to some research on volatility. But if you think about this, again, it makes sense that theta itself is overstated. Now, if I sell something that's 45 days away and people are expecting big moves, as they always are, but nothing happens, they're paying me for that time to be right, and it's getting wasted by the inaction of the stock, right? It's not moving at all. And this is especially true if you're getting directional. So if you're doing an iron condor and it's got to stay in between a range, you're really only profiting off of the theta decay there that's happening, as long as it stays in that range. If you're getting a position that's, say, bearish, and you allow yourself a buffer area, so say you sell a call spread, which would be a bearish position, and it's got a 30% chance of being in the money. That means it's a 70% chance of being correct. There's a 20% buffer there than just a typical buying of a stock or shorting of a stock, right? So between 50 and 70, 20%, right? So you're giving yourself a bit of a buffer. If you, well, let's just get into the to the bullet points. It's the same as volatility. If things move less than expected, giving more time means they can move more, but it doesn't mean that they will. So yeah, I guess where I was going with that before is if you get directional and you buy a bear spread and you sell a bear spread and you give yourself a buffer, and it stays flat or it goes in your direction and starts going down, then you're not only benefiting from the theta decay as well as the directional move, even if it is just ever so slightly. Okay, there aren't really any studies on theta that I was able to find. Definitely, if you find any, link it to me. But to me, it follows Vega very naturally, the same logic, and getting more time could help, but it probably won't. So anyway, how do I use this in my strategy? Well, first of all, if we notice something that we believe is inconsistent, then we can leverage that, and that can be a component of our strategy. Again, this is pretty much the same as the previous slide. So the idea is you get as many advantages as you can think of, and then you add them all together, and that should increase your odds of success over the general person that doesn't have a plan. They're just throwing positions out there. So here's a question. If there's a position on a stock that you could open, we'll say, again, selling a call spread, so I want the stock to go down. If it's 45 days to expiration and I can get a $100 credit, but selling you something 90 days out of expiration, so it's twice as long, we would expect at least twice the credit, so $200, but instead that nets you $250. Which one is better? And this one isn't actually always as clear as it seems. The argument for this whole video is that we should not shy away from longer expirations if we can get a good credit for it. But the next bullet point sort of muddies that up a little bit. For this one, it's not so clear because theta isn't linear. So you'll see the theta decay chart. It's really hard to do this in reverse. Okay, so the chart starts up here, and then theta will go down very, very quickly towards expiration. So, so sometimes it's really good to leverage that that drop, and that's why a lot of people recommend, and typically what I do is the 45-day expirations. So sometimes it might make sense to do this 45-day expiration, even though you're receiving less than half as much credit. And the way I determine which one I'm going to do is if that 45-day expiration is a credit that I'm happy with, then I'll go the shorter term because theta will have an increased effect on that position exponentially as the days go on, right? But if we sold that 90-day and we get the collected 250, the first couple days are going to have less effect, theta decay. And so that might be a position that we have to hold on a bit longer, depending on how the stock moves, of course. If it's staying flat, though, we would have to hold that longer than the 45-day. So what does credit that it looks like that I'm accepting? Well, for a $5 widespread, which is typically what I do, anything less than that, it's too hard to win, in my opinion. So yes, I still do them. I have one right now on AMD on a small account, but typically I do $5 widespreads, right? I like to get at least 130 credit, ideally 160. So if I'm in that 130, 140, 145, and it's a 45-day expiration, I'll take the shorter term so I can benefit from the theta decay. If I'm not getting that, say it's 110, which means it's not going to fill till, whatever, 100. That's not good enough for me personally. So I'm going to go out to the next expiration. Typically the same strikes, but you might even be able to get better strikes going out and still receive more credit. It just depends. You have to play with the numbers. But anyway, then I'll go to a further expiration, and that is something that I want in my portfolio anyway, because I want to have my expiration cycles diversified as much as I can. And you can see that really in the market crash that we've had here with the virus. Had I not had the varying expiration cycles, I would have absolutely blown up my account. As it stands right now, I'm down, $500-600. But that's something that I can make up easily. I was down $1,600. I had taken it from $2,300 the whole way down to $700. And so now I'm up to $1,500, $1,600 in that range. So anyway, so I'm not always against going further out. Maybe if it looks like it's 6 of one, half dozen the other, and my portfolio itself needs a longer expiration, then I'll put on the further out expiration. So the way I do that is by looking at the total collateral allocated per cycle, expiration cycle, and I can see that very, very clearly in Tasty Tracker. In each header, it says how much you have for that cycle allocated. To me, that's really, really important to say. I don't want to have all of my collateral on the next month in case something happens like a crash. And when of course it did right as soon as I started the challenge. But anyway, I don't have a hard rule there, but I we'll say 50%, maybe on the next cycle, and then another 25% on the cycle after that, and then 25% on all of the cycles after that. And then that's of the amount of money that you want to invest. And, I've said before that you should always leave some in reserve. So the numbers get a little bit hairy. You have to do what you're comfortable with, and you should always keep some in reserve. But I try to not have too much or all of it in the next expiration cycle, which, I've talked about many times before. Okay, I'll stop rambling. Anyway, my website's Tasty Tracker if you're interested. We now have a 30-day free trial, which I think is pretty great. and I am not a financial advisor. So if you have any questions, let me know in the comments below, and I'll leave it there. Thanks, guys.